Welcome everyone, and thank you for joining us on today's Cultivating Success Small Farms webinar. Today we're going to be talking about financial fitness for farmers and delving into actually income statements, not balance sheets. Cultivating Success program is a partnership of University of Idaho, Rural Roots, the Western SARE program, and the Food Systems program at Washington State University. Today's presenter is Kate Painter. Kate is an extension educator who is also an ag economist located up in Boundary County, so in Bonners Ferry, our far northern part of Idaho. I am Colette D. Phelps, your facilitator. I am an area educator in community food systems located on the Moscow campus. Just a couple quick webinar tips. If you're having any problems with your sound or speed of the slides changing and being in sync, you might want to close all of the other programs running on your computer, specifically those that are tapped into your internet, so you can have all of your bandwidth going towards the webinar. At any time, you could switch to a telephone. The call-in number is provided in your welcome email. When you do that, please remember to mute the sound on your computer so you don't get feedback. You'll see in the control bar that you can type questions in for the speakers at any time. You can also type in any needs for technical support. Handouts have been emailed to you, as well as a copy of today's slides. We will have those handouts also available for download from the Cultivating Success website, and we will have a recording of this on the website as well. So with that, I'm going to go ahead and stop my share and invite Kate to share her screen, and we are very, very happy that you joined us today. So, Kate, thanks for joining us, and you can share your screen at any time.
Okay. Just having a little panic here. I'm trying to find my screen. I got too many things open. What's going on here? I need to get back to Zoom and then share my screen. Oh dear. Why don't you share yours? Because I'm just having a little panic attack here, trying to find where I was before it flipped away.
Okay. I'm happy to forward the slides for you.
Hang on just a second. My sincere apologies for losing my place here, but I do not see my Zoom screen. I suppose I should still be connected here. Hang on. Well, I can't even see where I am at here, so just hold on just a minute here. For those of you, I'm going to start talking though. For those of you who were here last week, you had the lecture on income statements. Can you hear me?
Yes, we can hear you just fine.
Okay, so my Zoom is hiding here somewhere. Very strange. Okay, so I'm going to let you go ahead and forward these.
Okay.
So what is an income statement? This income statements and balance sheets are intricately linked. Oh, you know what? It was minimized. I have just found my place. Sorry, folks. I'm going to share my screen. Okay, Colette?
Okay.
All right.
Go ahead. Thanks for being patient with us, everyone. Sorry about the technical glitches this morning.
Okay. Can you see it now?
We sure can. You just need to put it in slideshow mode.
Okay. I had just a little too much going on this morning at the same time. Here I am, income statements. So income statements are really basic. but they're really kind of complex too. So they will summarize the revenue and the expenses for a given accounting period, typically 1 year. They're also called a profit and loss statement, same thing. Basically, it measures the difference between revenue and expenses. And if it's positive, you have a profit. And if it's negative, you have a loss. Seems very simple. And the way they tie in with balance sheets is illustrated in this slide. So in the example exercises that you got, we had a balance sheet prepared January 1, 2019, and basically January 1, 2020, and our accounting period was the 1 year period. The snapshots, which are the balance sheet, let's just say snapshots, I think, there we go. They're just a picture of where we're at that period of time. We often need that. And to tell the whole story of what happened between those points of time, we use an income statement for that year. Income, expenses, and profit for a period of time is what the income statement does. So it really tells the story what happened between those two snapshots. So revenue, by what I mean by revenue is income from production of goods and services. It can be non-cash, such as an increase in inventories, which is what will be in our exercise today. I sold fleeces from a hand spinning flock. It could be somebody owing you money, like last time I talked about I'd sold a puppy, but I hadn't gotten the money yet. So I had an account receivable for $200. But we're not going to include any income from off-farm sources, nothing unrelated. So expenses include your obvious cash expenses of feed, fertilizer, seed, fuel, but there also are some non-cash expenses that are truly expenses, and so we want to track those. Depreciation is one that can be quite large if you've got machinery or vehicles that are declining in value because you're using them up. It's a non-cash thing. You've already paid for it or you are paying for it, but they're getting used up in the process of producing your goods. Could be from use or age or obsolescence. And on the other hand, you have accrued interest and accrued taxes. And those just mean that those are accumulating. If you've got loans, the interest is accumulating on those. Everyone knows taxes, and so those taxes are accumulating. There's a bunch of noise in the background. I don't know if you need to mute somewhere. Okay, thanks. So the income statement format is standardized, and you start with all your revenue, and then you list your expenses. And the difference between those two is net farm income from operations. And then you add or subtract if you have sold something and you've made money or lost money on it. And that would be your net farm income. Maybe you've sold a truck and your depreciation was not equivalent to what the loss in the value was. So then you're going to have to adjust that. Okay, in case you're interested, all these pictures are from when I had my sheep farm. Okay, we're still hearing a lot of background noise, so if somebody's not muted, if they could do that, please. Okay, net farm income is going to be revenue less expenses, plus any gains or losses, like I just described, on the sale of assets, which may be nothing. I didn't usually have anything in that category. But basically, those that represents the return to the operator for unpaid labor and management and equity capital. So what I've invested in that business. And those I did not pay myself for, which is very, very typical when you're getting started or you have a small operation. You're not paying yourself a wage or for management or for the fact that you've got money sunk into your business. If you like this picture, this one became used in many sources, including on the cover of a book. Very typical for lambs to do that. Okay, so a big question and a big difference. You may have heard of cash accounting methods versus accrual. And this is important for you to know the difference. Cash accounting methods only track what was actually spent or received during the accounting period. Your balance sheets kind of keep track of that. So there are advantages. One is it's simpler, but another strong advantage is that farmers are actually allowed to pay their taxes based on cash accounting methods, which is why they will, if they have extra funds, they will spend and buy prepaid expenses. They'll maybe buy a piece of equipment. They'll do something in one year in order to reduce their taxable income. And they are one of the few groups of businesses that are allowed to do that. So often people will have cash accounting methods and accrual accounting methods. They'll keep them in both formats. Accrual is really important from a management standpoint because it is really, again, think accumulating when you see the word accrual. You're going to actually try to track what was spent or earned from a particular enterprise, whether or not it occurred during the actual accounting period, because you want to know, am I making money from that enterprise? So you can see why it would be important from a management standpoint. So if you're using accrual accounting, and I'll make a little stab at that today with our exercises so you can see what you might have to do. I think it makes sense intuitively. All my expenses for my sheet for this year's products, I want to subtract from the revenue that I got from all of this year's products. I might keep those fleeces into the next year as I try to market them, but I really want to know if I am making money from the enterprise that created the goods for it. So if you're doing very excellent accounting, you would want to know, okay, what kind of taxes did I have to pay on that? Do I have some accounts receivable that are still coming in? Do I have some bills that I need to pay? Those are accounts payable. Anything else that needs to be adjusted so that I know, am I truly making money from that product? Have I subtracted all the expenses? I know there's a lot of jargon, but if you just intuitively think that accrual accounting is really great from a management standpoint, because it will tell you if you're truly making money from that enterprise. And that's all you're trying to do. So accrual adjustments will include expenses that you've already incurred before the start of the accounting period. So you're going to have to do some adding and subtracting. And as I already said, there are benefits to both. The cash accounting methods are simpler, just tracking what came in and what went out for that accounting period. But you're going to have poor information. It's going to be confusing. You don't know if that money came in or is owed against the earnings from that year. And there are tax advantages or disadvantages depending on which method you choose. And it's very worth your time to look into. It makes a huge difference if you know that for some reason you have high taxable income this year and you doubt you will next year. You want to prepay some things in that year to reduce your taxable income. And that's just fine. It's not cheating. So the accrual methods more actually portray earnings and expenses for production of a particular enterprise. So for a livestock enterprise, you track the cost of all the feed you use to produce the market animals for that year, regardless if you purchased it prior to the start of the counting year. So if my only product was fat lambs, I would want to track the revenue from those fat lambs that I sold to be consumed against all the expenses that went into those. So some other accrual adjustment categories are accounts payable or accounts receivable. So things that people owe to you or that you owe to them. And then a tricky one is beginning or ending inventory. And because I had both fat lambs and hand spinning fleeces, I had a lot of inventory adjustments that would need to be made. One reason I'm really interested in this is I found it very hard as a person that was working off the farm and on the farm with the goals of maybe someday working just with my farm to know where I was at, honestly, and sadly to say, because it's complicated. So I'm hoping this exercise will illustrate why it's kind of complicated. So I one time had a whole bale of wool made into yarn. And so that inventory stuck with me for several years. Very hard to carefully track all that. Prepaid expenses, you may well buy all your hay in the summer. That would make sense. That some of that's going to be prepaid for feed into the next year. If I was growing my crops, I may well have made some investment in that before the season ended. Or you may be investing in next year's crop in the prior year. Okay, so just to let you know, I think that makes it very obvious that accrual adjustments are just going to try to track the correct expenses against the correct income. Excuse me. So profitability is based on your income statement. It's a relative measure, though, and whether or not it's acceptable, the actual level that you see will depend on the size and the goals of the business. Okay, so there are many different measures of profitability, and I'm not going to go too far down into all this jargon like you would get if you took a farm management class. But net farm income we discussed already. You could also look at the rate of return on farm assets. You could track all your assets and see how much you're making given the investment in your assets. You might also look at your rate of returns, your net farm income based on the equity you have in your farm, and that would be your rate of return on farm equity. You could look at your operating profit margin ratio, and we will go down and look at that. That's pretty common. Another term you might have heard in the economic sphere is opportunity costs. And in case you don't know what that is, excuse me, they are calculated as what your assets would have earned had they been used in the next best alternative. So you're choosing to use them for one thing, and it may be in the back of your mind that, wow, maybe this isn't the best alternative. So if you're never making money, you're never can pull wages from your little farm, you might start wondering about your investment in time in that hobby business, because you could be doing something else, maybe even making money somewhere else. Another thing, if you were not farming on the land that you're using, maybe you could have rented it. So your operating profit is your net farm income from operations, less opportunity costs of unpaid labor in management. And that would give you your operating profit. So if you truly wanted to know if you were making an operating profit, you would need to somehow put a value on your unpaid labor in management. Okay, the operating profit margin ratio is just your operating profit divided by your total revenue times 100. So let's do a quick example. If your profit from operations was $25,000 and your total revenue was $150,000, you would just divide 25 into 150,000 times 100, and it would be 17%. Okay, let's look at change in owner equity. That is the value of what you own in your business. And you may have heard the term retained farm earnings. You're making money from your farm, but you're leaving it in your business. You're not removing it. And that's very common. You're just reinvesting the value of your labor, the value of what you've earned. You're not taking it out. You're just reinvesting it because you're growing your business at this point in time. But if your living expenses and your taxes are higher than your total earnings, then your owner equity will fall. And we'll look at that in our example. I think it'll be a lot easier to understand what you're trying to get at from a real world example. So to summarize, an income statement summarizes revenue and expenses for an accounting period. Net farm income or profit is a dollar amount, while profitability is a relative measure depending on the size of the business. Okay, you should have a handout or two. It goes through kind of continuing the story from last time if you were here on that, where we had a balance sheet for 2019, January 1st, and January 1st, 2020. But we wanted to look at the story of what actually happened. So the income statement tells the story for 2019. We had $1,200 in fleece sales, $7,800 in lamb sales. I sold a few ewes that were either too old or needed to be culled for $480. And I sold $2,000 worth of guard dog puppies for the gross farm income of $11,480. So that is my revenue. Here are expenses, and the simple ones: grain, hay, straw, dog food, veterinary. You can see that I'm not paying myself any labor because I'm investing that and I'm building my business. And the bottom line of interest on loans, I'm reducing my, I have some bills owing that we talked about last time, some loans that I'm paying interest on, and that also comes out of cash farm expense, the interest portion owing on those loans that are due this year. So my total cash farm expense, once I put the interest portion here, is actually $11,356. And the difference between the revenue and the expenses, the cash farm expenses, is a net cash farm income of $124. Well, you know, I was usually trying to aim for investing in my business, and really net cash farm income of break even was fine. That was part of my goal, is to be investing and growing my business. And I didn't really need more taxable income because my husband and I both had off-farm jobs. But really, that doesn't tell the full story. I want to look at what was going on with my inventory, feed, accounts receivable, fleeces, market livestock. You could see, if you still have your balance sheet from last year, that there was quite a bit difference in that snapshot. In January 1, 2020, I had $1,200 more feed purchased already. I had $200 less in accounts receivable because I had no accounts receivable January 1, 2020. I had $800 more fleece inventory, $1,000 more market livestock inventory, and $500 less in prepaid expenses. So the total inventory change was $2,300. Well, that means that I was really further ahead then, doesn't it, for that accounting period? The income statement shows me that my net operating profit was $2,424 because of the change in inventory and expenses. So that's important because you want to have those going to the right period of time. And so that's good. That would make you happy to realize, oh yeah, I forgot about that. I really am further ahead this year. And then to bring you back to reality, there were other ownership costs, and these are non-cash expenses that you should really keep in mind. And that is that the value of things that you have purchased are going down as they are being used up. So the choices that I made in terms of the value of what I had, what it would be worth over some span of time, we talked about this last time. And so what was being used up each year is a non-cash expense. So for example, my trained border collie I said was worth $1,000, and it would be good for 5 years. as a trained border collie. So if you take $1,000 divided by 5 years, you are really using up $200 of that money every year. These are all just your best guesses, estimates, but you know these things are being used up. Machinery is another thing that's really hard to know what's going to happen in the future, what kind of repair costs or what kind of length of life you will have, but you know that it's an annually you're using up value. And so purchase livestock, going down in value as I use it up, that was the ram. There's notes, I think, somewhere on that. The working dog, machinery, other vehicles. We all know our vehicles really depreciate. Barns and fences, another huge expense, going down. So the total depreciation value for the year, I estimated at $2,530. And then there's one more category. So the interest on retained livestock. All that means is that you have capital sunk into your breeding livestock that you're keeping year after year, like your breeding ewes. And there is a cost to putting your money there versus somewhere else. And so that's why you make a category, interest on retained livestock. So in this case, my total ownership costs are all the depreciation and interest in the business, and that's $2,855. So when you add in inventory changes to get your net operating profit of $2,424, then you subtract out your estimated ownership costs of $2,855. The net farm income is minus $431. So, discussion questions. You know, whether or not I'd be happy with this bottom line, actually, I would be fine with that because I didn't need to make money. I was already had an off-farm job. I was meeting my goals of growing my business and paying off debt. And I know that some things were going down in value, but I was actually pretty close to break even. So in my case, I thought that it was not an uncommon situation when someone has a farm they're trying to do in their spare time, build it up to maybe someday doing something else. For me, it did work out because I decided to try selling things online. And I put my police sales online in the mid-90s, not really thinking that people would buy anything online, especially something so tactile. But I was quite wrong. And in time, I had $200,000 in sales off my website the year I sold it. So anyway, to do that, you have to work really, really hard, which I did. And I did have a few years where I did not work off the farm. So when I look back at it, it was stressful. It was a lot of work. And even though I was an ag economist, I really struggled to know where I stood and how I was doing. But I think one of the reasons that I ultimately was successful and able to sell Paradise Fibers for good money, and they bought my inventory and the whole thing, was because I was constantly thinking of, and being flexible in my mind. Is this working? Is that working? That, you know, something I thought would work wasn't, and something I really didn't think actually was. And that does require sharpening your pencil and constantly trying to analyze little aspects of your business. Okay, I believe that's all I have here. So we have time for questions.
Right now, Kate, we don't have any questions that have come in, so I'll give that a couple seconds. And while we're waiting to see if the audience has any questions, one of the questions that comes to my mind is when somebody is thinking about preparing these type of income statements and a balance sheet for the first time, what kind of documents are they going to need to gather to be able to do that?
That is such an excellent question. Record keeping. Record keeping is so critical. Back when I was trained in farm management, the non-digital age, I had a mentor professor that I worked with for years, and he always recommended that you use one of those bank registers that comes with your checks and have them, devoted to your farm. So my sheep farm, if anything that I did that had any financial implications, to write that down with the date. Of course, you're going to want to keep receipts, and in a digital world, maybe people would write that in I know some farmers just actually write it in some note program and then save all of those. Some way to track anything that has to do with a business related expense or something that has financial value. And then you can go back and put that in the right categories. But to have the data, to not have the data makes it really hard.
Exactly. We have a great question related to this conversation, and it seems like there's a lot of guesswork in some of these numbers. Is that a true assumption?
That is definitely a true assumption. And part of that is because there is a lot of unknowns. For example, you bought a vehicle and you thought it was going to cost you about this much. And we all know that sometimes they perform better or worse than expected. So you can adjust that at any point in time if you realize that as the years go by, oh, really, that vehicle was a good deal. It's really hardly costing me a thing, so my annual expense on that I can reduce, and vice versa.
And if this is something that folks are starting right now and they have, let's say, a vehicle that has depreciated over time, that might be some calculations that they need to figure out. For instance, if they bought their farm truck in 2010 and it's 10 years later, so they already really have 10 years of depreciation, they could figure out the value of the truck when they're starting to do the record keeping.
Okay, we are going to talk about this next time when we do enterprise budgeting.
Okay.
Exactly how you do that, because that's something I've done hundreds and hundreds of. So we'll talk about how you do vehicle expenses and enterprise budgets. So
okay.
that's kind of a nice little segue to next week's.
Okay, great. We have some other questions. The next one is about opportunity cost. Is opportunity cost including your friends, your family, your labor, your friend and family labor put toward the building of assets in the form of outbuildings and fixing machines? I'm sorry, that's not really clearly worded. Let me try it again. Is opportunity cost including yours, your friends and family's labor put toward the building of assets in the form of outbuildings and fixing machines? So I think the question is that, it's not only your own time that's going into these, but also the time of your friends and family that are helping you build those assets. Do you consider their time also within an opportunity cost?
That's a great question. I love it. But I think that, I'm not sure, but I'm guessing that the way it is meant to be is I am looking at whether my farm is profitable, and I could have been driving school bus or something in the hours that I have spent. And so that's an expense because it's an income I gave up. But other people, I don't know, it's more like a donation or free labor. I don't think that because they're outside the farm, I don't really think that would be considered an opportunity cost, because it's they've either decided to give it to you for free or they don't. There isn't an opportunity cost there for you.
But perhaps if it's, for instance, a family business that might be operated as an LLC, and there's multiple people that are putting their labor into that business rather than having, let's say, an off-farm job or a different type of, self-employment, then that would be looked at perhaps more wholly on a business level.
Oh, yeah, yeah. And so if say it's you and your wife, your children, and they're all part of it, they're all partners, then all of their opportunity costs. But if they're just friends that are doing it because they like you kind of thing outside the business, they're not part of business. It would not be.
Okay, great. Thank you. Another question. Can you use the interest cost on equipment that was purchased prior to starting the farm?
Well, no, I'm thinking, I'm not quite sure what the purpose is for. Usually we just go forward from where we are right now from when we start the farm. I know some, am I missing that?
Well, as I'm interpreting the question, and if the participant that submitted the question, if I'm interpreting the question correctly, I think it is when you take a piece of equipment that you already have purchased. Let's say you bought a Kubota tractor because you have a lot of snow and you move snow and you're making payments on it. But then you decide that you're going to develop a farming operation and you put that tractor then in service of the farm. Can that current interest cost be accounted as a farm expense?
Only that portion that is proportional to probably the hours used that is used for the farm. So you would only be able to deduct it both the tax standpoint and if you're trying to do your accounting to see if you really are profitable in that business. But so you have to do, I'm using it 20% of the time to shovel snow and 80% of the hours on the tractor are used in the farm. You have to divide it.
Okay, that makes sense. So then that interest cost would be divided 20/80, depending, or whatever the use is. Okay, great. Another question. Do you value assets built with unpaid labor relative to the total amount of materials and unpaid labor? So if you, build something yourself.
That's a great question. It should be the fair market value of that asset. I mean, that would be one way to look at it, would be would you be willing to sell it for? Maybe it's hard to say because you're building fence or something, but you try to get at a true market value. So what would it cost? You could look at what would I have to pay someone else to do it for me, like a custom done fence. In that case, you would help you get at the value of the labor in that. So if I didn't do it myself and it had to be cheaper because I didn't pay myself, but it really has more value, obviously, because it would cost you $1 a foot or something to have somebody else do the whole thing. So we often look at what would be the custom rate, what we'd have to pay someone else to do it, or the fair market value if it's something that's a little easier to sell, like a trailer.
Okay, great. Thank you. Those are all the questions that we had today, Kate. So thank you very much for providing those examples and the handouts. And I want to go ahead and hand it over to you to maybe talk about the benchmarking project.
Okay, thank you, everyone. I do apologize for being a little flustered. I had a million little emergencies this morning, and so thank you for bearing with me. I want to talk about the Farm Business Management and Benchmarking Grant that I'm doing with some of my colleagues. It's very exciting, and what's pretty exciting about it is it's not just your large conventional farms, but they're also doing some benchmarking for smaller farms as well. So if you go to the Idaho Ag Biz website, and basically if you Google Idaho Ag Biz, as you see it there, it will come up. And on that, it does have a sign up link, or you can email more about it. And we have this wonderful grant that we have hired someone to do one-on-one assistance to help you develop your financial forms, the balance sheets, we talked about last week, income statements. We talked about this week. I believe it's budgets in our webinar that are going to be talked about next week, and then cash flow statements the week after that. But those are your standard farm financial statements. And then there, you would also get free access and training on FinPack, which is a very thorough and long-running financial package for analyzing your farm businesses, and tracks all these things like your machinery and all this stuff. So you will get free access to a really excellent farm management software. And you also get credit if you're trying to get a loan through USDA Farm Service Agency. It will help you get a lower interest rate if you do this benchmarking program, because it satisfies the beginning borrower training requirements. What you'd have to do is provide your farm financial statements. So you'd have to have good records. If you're just starting, this is probably not something for you. In return, you get a whole farm financial analysis, a free trial for FinPack with training, and assistance compiling the statements. So that is under Idaho Ag Biz, and there's the actual link, but it does come up pretty easily from a Google search.
Okay, great. Kate, we had a question if that program is only available to Idaho farmers.
I believe so. I believe it's only Idaho farmers.
Okay, thank you.
That would be a question too. I can double check that.
Okay, great. Thank you. Well, if you'll stop sharing your screen, I will share mine and we'll wrap up today's webinar. Okay, everyone. So just a reminder that you can go to the Cultivating Success website to find our current programs, sign up for the next webinars, and to find all of our recorded webinars. This is what's coming up. Next week on Monday, we're going to have a webinar on assessing beneficial insect habitat on your farm. And then on Tuesday, we'll have part 3 of the Financial Fitness for Farmers series looking at enterprise budgets. The week of the 24th, we will be talking about cash flow statements. So we hope you're able to join us for those webinars. And again, please take our post-webinar survey. It's really helpful to us in terms of our program evaluation and the reporting that we need to do. So here you see the link, and this will go ahead and it will launch in your browser after today's webinar. With that, thank you for joining us today and have a really great afternoon.